Good morning, good afternoon, or good evening, wherever you are in the world. We have a lovely webinar for you today, Indian Gold Demand. So we have 5 speakers for you today. I think one of our biggest panels ever. We have our host, Jeremy East, the Senior Advisor for Asia from LBMA. We have Professor Arvind Sahay, Marketing and International Business at IIMA, Shekhar Bhandari, President and Business Head of Kotak Mahindra Bank, Somasundaram, PR, Managing Director, India at the World Gold Council, and Sudheesh, Nambiath, Head of IGPC at IIMA as well. So without further ado, Jeremy, if you would like to take the floor.
Thank you very much, Taylor. Today, I think we're going to talk about 2 main themes. The first is really going to be about the changing landscape of the Indian gold market, the developments in terms of regulation and what the India gold market is going to be doing in the next sort of 5 to 10 years, which is quite dramatic, I think. And of course, the unfortunate impact of COVID on the current market, and the impact of COVID on the potential acceleration of changes in the India market, or perhaps the delay of change in the India market. London, over the years, has been really built on governance, on standards. And that really was being reflected through the LBMA's work of good delivery and having the London benchmark, so a transparent pricing system for gold. And that's really been sort of the center of the London gold market. And it's interesting to see how India potentially will be going along the same line, looking at the same sort of fundamentals and building blocks that led to London being the global center of gold trading. And of course, London has a big connectivity with India. The LBMA good delivery list are center to the suppliers of gold to the Indian market. And the supply of gold to the Indian market is generally priced against the London gold market. And that may be changing. The India market may be setting up its own benchmark. So as with China, becoming a price maker rather than a price taker. So let me start with introducing Arvind and Sudheesh. Their focus is mainly on the policy regulation side, the building blocks, as I said, of developing the future India gold market. They'll touch on the areas such as infrastructure, the gold exchange, and also what's going to be happening in the future in terms of research and data. So let me hand over to Arvind and Sudheesh, and we'll start interested to hear what's going on in India.
Thank you very much, Jeremy, and for giving me the opportunity to go first. But since we are talking about demand of gold in India, I have to confess that at India Gold Policy Center, our focus is less on immediate demand and so on. So may I suggest, with your permission, Jeremy, that I will request Somasundaram and Shekhar actually to lead the way on the demand part. And then Sudheesh and I will talk about how IGPC kind of fits into the whole theme of gold in India, and how we are trying to make the gold markets in India to contribute towards it becoming more efficient and more scalable than has been the case so far. So why don't I go with Som and Shekhar first?
Okay, sure. Yeah.
Sure, Shekhar, would you like to start?
Yeah, I think I'll just start with what India is, where we are in the present, and how does it look, I think, in 5, 10, and 15 years. I think the present is COVID-19, and the number of COVID-19 cases are rising in India. We have seen it in the developed world, especially in US, in London, UK, and Europe. The second wave is here. Different states in India have imposed restrictions of varying degrees to control the growth of cases, and that has put immense strain on the business. But if you were to look at last 12 odd weeks, you would realize that last 4 weeks were control and 8 weeks were full business. And that showed in every matrices, I think, which we measured, mobility in terms of consumption, production. We saw our activity levels at 110% of what it was happening pre-COVID. So January 2020 and March 2021, I think you saw somewhere around 110% of the business. And that was quite healthy till the time the lockdowns came in. Specifically for gold, you will see that I think there was an import of around 312 odd tons, I think, which happened, and that was a strong recovery. So if you were to say the volume was 200% up on a low base, but even on a normal part and etc., it was 55% higher than the average over past 15 years. And that means that pent-up demand, some amount of calibrated, some amount of allocations and reallocations, a better performance of gold, all translating into it. If I were to see the consumer demand estimates for the coming months, I think they look subdued. And but let me attribute three, I think, structural changes which COVID has brought, and I think the way it helps each of us to understand the consumer and the demand pattern. We have seen, I think, a shift towards savings much more than I think what it was pre-COVID. You have seen a shift of on an average 400 to 700 basis points in terms of the savings rates, which has gone up in terms of financial savings. And we have seen an allocation to gold similarly, I think, moving as well. Second part, we have seen a move towards digital, and rightfully, I think, technology being an open source and available to everybody, but I think COVID ensuring that it has to become contactless, simple, and for everyone to be consumed at home. If I wanted to feel a gold coin earlier, I'm very happy to get delivered at my place if there was an option available with the security and authenticity granted. The risk management has become a very important part of personal life besides the professional life. So when we say COVID-19 ensure that you take care of yourself, your wealth, and a sustainability over a period vis-a-vis what we would have seen in pre-COVID world. And all these three parts put together, I generally say and frame, I think, the behaviors. I've seen that the weddings have happened. It has become less compared to what it used to happen normal, but allocation to assets have gone up, be it allocation for house, be it allocation for gold, be it allocation for savings. And this everything is coming from the big spends which used to happen on wedding getting reduced with 10% of the normal invitees which would have been there on the list, the functions happening at home, and a lot of commute, travel, food, everything, I think, not actually happening, resulting into a saving which actually go into the investment mode. In terms of the second part, I think the 5 years, 10 years, and 15 years, the Indian demographics are quite favorable. The demand patterns are going to be driven by the increased number of people who enter in the range of 18 to 60, and each of them seem to be, I think, be on the course of savings, and savings having a bit of a fair share, I think, wherever they lie. There is a question which is definitely asked to me is, do you see the millennials shifting towards financial assets a bit more than the physical assets? The answer to that generally is in the data and in the mind. Has the proportion come down? Answer is yes. Has, in absolute sense, it has reduced? The answer is no. And when we see that proportion actually getting transformed, you realize that it results into the 20-25% YOYs happening automatically thanks to, I think, their preferences.
Interesting. Thank you. Som.
Thank you very much, Shekhar. Covered some very, very important points there. Clearly, in terms of the demand itself, we saw it really growing in the first quarter. We released our demand trends. We saw a 37% jump, although it was a low base last year. But a very interesting insight here. Last year, this was not a COVID quarter. Quarter 1 2020 was not a COVID quarter. Yet, it was one of the lowest demand quarters. The reason was, ever since July 2019, with US interest rates, the prices started rising. And so by the time quarter 1 2020 came, people saw the prices rise to 42,000, 43,000 rupees for 10 grams, which they found compared with 32,000 rupees was a big jump. So they were very, very skeptical about this price rise, because consumers always look, they want the price to go up, but they just want to be sure that it's a trend and not a blip. So that's the mindset of consumers. I buy gold because I know it will go up in prices over the long period of time. But when it goes up at the point of shopping, I want to be sure that it's not a blip. So last year they were not very sure. Quarter 1 2020, people generally stayed away from gold. It was one of the lowest quarters, 101 tons. Against that price, quarter 1 2021 was actually 14% higher. Although it went up to nearly 28% and then came down, 25% and then came down, it was still higher than quarter 1. Yet people bought 37% more, which means in value terms, they bought nearly 50% more. So that shows the resilience of this market, of the demand, when things were to come back to normal. Obviously, things changed since. And as Shekhar said, trade was more optimistic because they were looking at Akshaya Tritiya tomorrow, day after. And they actually imported 310 tons. So against a demand of 140 tons, you had an import of 310 tons. Because the trade was more optimistic. They saw the consumers coming back, they saw prices softening a bit, and then they said, oh, this is going to be a great Akshaya Tritiya and wedding season. Unfortunately, that is not to be. And we have seen a crisis, but the quarter 1 actually gives us a glimpse of what we can expect when things come back to normal. There is a pent-up demand which will come back. And while Shekhar did mention about contactless, I hate contactless gold. I want gold. I want to hold gold, and I'm glad many of my countrymen like it that way. It's actually something. If there is one thing on this earth where there should always be a contact with, that should be gold. So it brings a lot of joy. Given that, how do we see this demand for the current year? One of the things is it's very difficult to estimate. Yes, trade has stocked up, but there are some fundamental changes. It's very, very important to see how the Indian market is changing. And it's not all related to gold alone. What demonetization did in 2016, ever since, we have seen a lot of steps taken, not directed at gold, but directed at the overall economy and the tax compliance broadly in the country, which have actually impacted the gold market as well, because gold was earlier a beneficiary of some lax practices in these areas. Now we saw that shrunk, and that is the reason why we saw generally gold demand dropped down to an average of 700 tons against 900 tons in the past 10 years. Okay, and it's nothing to do with prices and other stuff. It's got a large amount to do with the government's push towards transparency. Now, what has that done is it has brought organized players more into the market, and they are probably bringing practices. They are bringing a sort of innovation. Their marketing language is changing, which is very, very good in a way, because as we see the next few years, with 45,000 and 50,000, as I said, quarter 1 told us one thing: the high price of 45,000, above 40,000 is now acceptable to the consumers. It's a very, very important thing. Obviously, you have to wait and see how the post-COVID reacts. But at these high prices, what is going to happen is consumers are going to demand more trust. You're not going to buy gold the same way at 45,000 and 50,000, the way you are buying at 30,000. It's a lot of money. People have lost incomes, right? They have lost livelihood. When they are buying gold, you got to give them something more. and can't simply say, no, you know what, the gold is going to go up to, 70,000 rupees, buy gold. It's not going to work. So that, with the government's measures on transparency, I think it's going to bring a lot of change in the market. And I have seen it over the years in my career. The direct benefit of many steps are far lesser than the collateral benefits in India. You bring a certain thing, the direct benefits, you estimate it will do certain things, but I've always found, the various examples, the collateral benefits actually at some stage take over. They become much bigger than the original objective itself. That is what is going to happen to the industry now. And industry is not, I wouldn't say fully ready. The organized players are, and we saw quite a lot of even IPOs coming through, but the rest of the industry probably have to, pick up faster than they think, rather than always, presenting cases how they cannot do the right thing or how they cannot adopt this practice or that practice. It's going to happen. And with the government also, and with the consumers also now focused more on value, I think it's important we have as an industry to say how at 50,000 it is now valuable to the consumers. So this is going to be a big theme as we go into the next few years. And as I see it, organized players are going to benefit much, much more unless the rest of the smaller players also join common platforms like a mandatory hallmarking. Pushing it further ahead is not helpful for the smaller guys, because hallmarking means what? Anything hallmarked is acceptable, trustworthy. That's what the government says. Now you are pushing it. What are you saying? Go to the big boys because they are more trustworthy. The smaller guys, we can't do hallmarking. Now it's actually in a way not benefiting them. So you're going to see all these themes come back into play, and we will have definitely a stronger market, but we will definitely also see quite a lot of the players, non-compliant, etc., dropping off. So I would stop with that, and Arvind and Sudheesh can join.
Yeah, thanks, Tom. I think you're touching on an important point, because sort of over the years, India has been sort of maybe decentralized. It's intransparent, and so I think what the changes that are coming are big changes for the industry. But obviously, with hundreds of thousands of jewelers all over India, it's going to be a real challenge to be able to address or to fall in line with the new regulations. But it looks like that's the way it's going. Let's hand over to Arvind and Sudheesh.
Very interesting that you say that, Jeremy, but because in a sense, that's exactly where a body like the India Gold Policy Center comes in, which not coincidentally was set up with the support of World Gold Council a few years ago. And our remit essentially has been to be an independent research think tank that does data-based research to provide insights that can be useful to both the industry and to the government, and also to do policy advisory. And that is important in a context like India, because the industry has always been quite fragmented. And the data which was neutral, which was not having a particular slant, was really not available. If you talk to one part of the industry, you would get a certain view. If you talk to another part, you would get another view. So there was no real way of kind of assessing what was the reality. And that was a part of the reason for the lack of transparency in a sense. So what does IGPC do? What does India Gold Policy Center do? We do research, database research, policy advisory, and help framing some of the regulations also more recently. So let me talk a little bit about those three dimensions, the research and the data collection, make it much more neutral and independent, and the advisory in turn. So for each one of them, I'll take a little bit, one or two examples to kind of illustrate the idea of how things are changing. On the research part, our latest paper, for example, and this is not just based for India, it is globally. We show that for 48 countries over a 20-year period, central banks that have held gold reserves the greater the amount of gold reserves, the lower are the CDS spreads. So essentially, the markets tend to think that the volatility and the uncertainty in a particular country is negatively correlated to the amount of gold reserves held by the central bank of a country. So my colleagues Sanket and Sawan and we kind of did this piece of research. It just got published, by the way, in Finance Research Letters. We also tweeted about it a couple of times, and WGC also has a copy of this. So that's one bit of research. Another bit of research, for example, looks at what is the nature of the working conditions of the workmen who actually do the jewelry manufacturing in different parts of the country. That's a second dimension of research that we do. The third dimension of research is much more applied. What should be the steps that one should take for the regulatory aspects of particular initiatives which are being taken? And for two of these particular initiatives, the International Bullion Exchange and Bullion Banking, I will ask Sudheesh to kind of tell us a little bit about what IGPC has done for the International Financial Services Authority and Ministry of Finance over the past 1 year, even during our COVID times. I will talk a little bit about recycling and GMS, a little bit about mining. So for example, earlier this year in February, the Ministry of Finance has proposed various amendments in the gold monetization scheme and the GML through an office memorandum. And this is expected to be followed up by the Reserve Bank of India, SEBI, Securities and Exchange Board of India, and the IFSCA, who will issue necessary notifications that will provide for example, repayment of gold metal loans and physical gold, including Indian good delivery gold. So all of these things will facilitate the movement of gold in a more quicker manner than has been the case, and it will allow more participants also to come in and take part in the market. And the option of drawing gold collected by the jewelers under gold monetization scheme for their own consumption as disbursement within the authorized gold metal loan limits is also under examination. And if all of this is implemented with the appropriate safeguards, it has the potential to eliminate processes, many of the processes that are currently there. So let us see what happens over here in terms of GML. For mining, India is the largest consumer of gold, and we hardly produce any gold. Now, the MMRDA, the Mines and Minerals Development and Regulation Bill, which was passed recently on 28th of March, just over a month ago, that should help unleash the potential of untapped mining reserves if all goes well. And for those of us who are familiar with India, things always tend to take a little bit longer than they normally would. But given that we are moving in the right direction, my sense is that we should be having over the next 5 to 7 years production of gold, substantial amounts of production of gold. Sudheesh would like to say 100 tons. I'm a little more less optimistic. So I will say that let's just say a substantial amount of gold production should start happening in India. Similarly, in terms of hallmarking, last year in January, there was a gazette mandating that effective 15th January 2021, all the jewelry sold in India should be hallmarked. And as Som has already alluded to, this should lead to more consolidation in the industry. With the current level of prices, people should gravitate more to organized players, and organized players in general have a much higher level of transparency, responsible sourcing, and everything as compared to the smaller players. Of course, this has other ramifications that we won't get into. The other part that I will very briefly touch upon is this whole business of trying to understand the consumer sentiments in relation to gold at the national level. So we have started an initiative where we are collecting data on gold consumption across the country using a panel of 210,000 households, from where we sample around 40,000 households on a yearly basis to get a sense of how much gold has been bought, for what purpose, how has it been bought, what has it been used for, where did they hear about it, did they make use of gold metal loan or gold monetization scheme, and so on. So this exercise started last year in October, November, once the first phase of COVID kind of went down, and we started the sampling frame around that. And by around March, we had completed the sampling frame and we had started collecting the actual data. And then, of course, the second wave has hit us. So we are kind of bang in the middle, and we have suspended operations, and we should resume again fairly soon. But in the interim, we do have some bits and pieces of information from the households that we have touched, even from a sampling frame perspective. So, for example, out of the 210,000 odd households, 44% have reported ever purchasing gold in any form. Now, that's a humongous number to the extent that it is a representative sample of households that buys gold across India. India has 280 million households. If 44% of the households have purchased gold, so nearly 124 million households have purchased gold in any form, not necessarily immediately in the previous year, but over the last 5 years. Of course, this also means that 56% of the households have reported never having purchased gold. So much for gold being a part of the cultural milieu of India. And
is it never purchased or never reported? What is that?
That is a good question. I would like to think that it is never purchased rather than never reported. Having said that, our modus operandi of collecting the information and the people that we use are known in the local community. So we are a lot more confident that the responses that we are getting are likely to be more correct rather than not. The other bits and pieces of interesting information that are coming out is, for example, that awareness of exchange traded funds and gold bonds and gold monetization scheme is not very high. So, for example, only 15% of the households have reported awareness of gold monetization scheme. And out of these, only 2.5% have reported, that we have actually availed of the gold monetization scheme. And for exchange traded funds, the percentage is somewhat similar, 14% report having heard about it. And out of that 14%, a mere 3.9%, so 3.9% of 14%, that's a very, very small number, have actually availed of exchange traded funds. And while the awareness of gold monetization schemes, exchange traded funds, and digital gold is the top, amongst the topmost income group, is much higher, the conversion is much lower. So interestingly, on average, while 15% of the households report having heard of GMS, the awareness in higher income households is higher. It's as high as 25%. But the use of GMS in that 25% is actually lower, which makes for an interesting marketing challenge that if a larger amount of the gold that you want to come back into circulation is actually lying with the higher income households, where the conversion is lower, even though the awareness is higher, how does one get people to convert if you want to do that? So that's a second bit of information that I wanted to share with this group about the survey that we are doing. This survey is now going to be an annual survey. I am hopeful that over the next 3-4 months, the survey will be complete and we will have a much more nuanced and detailed pieces of insights that we can report. And we will hold this now annually for at least the next 3 years, so that at least we have a database now that will now be available. By the way, the database will be an open database which will be available for industry to do research on. Of course, we will do our own research and we'll report our insights as well.
If I may just step in here, it's to say World Gold Council gives an overall demand, aggregate demand for each country, including India. We go into bars and coins and various this thing, but this is going deeper into why households buy, who are the households which are buying, and it'll complement what we already have in terms of this. It's going to be very useful for the global industry as well to understand this, and also for the Indian industry in particular.
The last point before I ask Sudheesh to talk a little bit about the International Bullion Exchange and bullion banking, probably two of the biggest initiatives in recent times, is on the taxation part, especially about customs duty, which is still, even after the reduction in the last budget, is still fairly high. And at IGPC, at least my view always has been that that's not really required. But it's very hard to convince the government when you have 22,000 odd crores of revenue and Department of Revenue seems to think only in terms of revenue. But hopefully that should change over a period of time as more gold gets organized automatically. The evidence that it is counterproductive should become more data based, and that should lead to some changes. So let me ask Sudheesh now to tell us a little bit about the International Bullion Exchange, where the IGPC has been involved very closely in terms of setting up the regulatory scaffolding, how it is moving along, what we anticipate happening over the next 1 year, where it is just now, and also associated bullion banking activities. Sudheesh.
Thank you, Professor. Hello, everyone. It's great to be here. So let me talk more. Let me talk about the International Bullion Exchange, and then there's this domestic bullion exchange. And the success of these two are going to be linked to how the bullion banking is going to take off. So the first such initiative was started off with the International Bullion Exchange, and we started working with the IFSCA on that front, on an advisory capacity. Uh, so if, the whole purpose, if you look at, is to create a world-class market infrastructure. Why? For connecting India to the rest of the world while making sure the governance and the technological progress, which are going to be key pillars on which it is going to build. And it helps integrating the gold, India's gold trading with the international uh, gold trading. And over the years, we intend to make it a international trading and vaulting hub. So it is not just about going to be the import of gold into India, but it will also be about trading gold in the international market through the IFSC area. As the IFSC area is known as the International Financial Services Center zone, which is a free trade zone. So there are various uh, various things that's going to help this become success. And quite a lot of regulatory changes are being worked on those fronts, which we are sure are in the process of being ironed out. The one of the major activities that's going to happen is with respect to the bullion banking, where uh, where just about a month back, sometime in March, they released a circular related to the opening of the unallocated accounts by the international banking units based in the IFSC. So it's going to be a facilitator for the Indian banks. Of course, when the RBI is going to allow the domestic banks to start using the unallocated accounts through the international banking unit. That's one part of the business. Second is about, as of now, a lot of the trade has been on the consignment basis. We expect a lot would move out from consignment, and it will be more on an outright basis transaction is what is going to happen to India. Of course, it's going to evolve over time. It's not going to be just one day all of a sudden. And the third is the development of the domestic gold lease market. That again is related to the unallocated accounts and the opening of the unallocated accounts. Now, what happens here is currently the Indian markets are, Indian banks are largely borrowing from the international bullion banks and lending it to the domestic fabricators. Uh, how we envisage is the banks, Indian banks are actually would start buying it outright and hedging it in the international OTC markets, on the gold forward and the USD INR forwards, and they will be fixing their own rates and lending to the market, which can actually turn to be much competitive to the international leasing rates. Of course, depends quite a lot on the market fluctuations. So these are three key developments that will be happening if I have to keep it short. And where do we stand today on the international bullion exchange? How it is being formed is there's a consortium that's been formed of all the three major exchanges and the depositories. They're going to have so these three exchanges and depositories together would be having certain percentage, and further to that we'll be having more foreign institutional participation to start off the International Bullion Exchange, or rather register the International Bullion Exchange as a company. And so what is the role of the domestic bullion exchange, if you may, if you were to ask? The domestic bullion exchange and the international bullion exchange, they both are actually going to complement each other in their activity. So as you are aware, the gold in India is a restricted item. So not all can directly import gold. One needs to have a license. And that came to effective from 2019, from 2019. So how do we pass on the advantage for the domestic jewelers and the small bullion dealers? So one of the best way is through the domestic spot exchange. So there's going to be much more better price discovery on this market, on the domestic bullion exchange market. And they are going to have an option of either deliver it directly to the exchange, or reach out to the customer. The market, the market infrastructure, or if I had to say how the exchange model is going to be constructed, if I were to say, it's going to be more on basis of the incentive that one is going to have, which we believe is going to be quite strong to deliver it on the exchange, and then the domestic spot exchange. So over the years, how, if you had looked maybe 10 years down, we'll have a lot more jewelers and smaller bullion dealers all willing to participate and buy through domestic spot exchange directly. And on the other hand, the international bullion exchange, the international bullion exchange would be a node for the price discovery of the Indian market. So we want to add something there? Yeah.
Sorry. Sudheesh, would you probably say, I mean, we have worked on this, and even Shekhar can join here. Don't you think that more than the trading platform and the amount of volumes that we are going to see, what these two initiatives are doing to the ecosystem is more important? Like 2 years ago, we were just talking about good delivery. Today, exchanges are willing to take a call on, at least within the Indian refineries, there are only 4 or 5 we will even consider. The rest we don't consider unless you do these things. That kind of a discussion 2 years ago would have been very difficult. Today, it is the norm. So would you say that the benefits, again, I come back to my point about the collateral benefit, the collateral benefits of organizing this market, the ecosystem around the good delivery, allowing refineries to be audited, they are going to be far more important than, in absolute terms, the volumes. Shekhar, I would also like to think about your view. I mean, as a banker, would you be more, would you look at these rather than just the volumes in the initial phases?
I think it is important for all of us to realize that the Indian market has evolved significantly, and especially in last couple of years, be it in the form of structural change from unorganized to organized, from something which was fragmented to actually being transparent. The trust levels, the way they were there, I think 5 years back, and the way it stands today, the level of compliance by all the players of the system, I see that there's a significant improvement, I think, which has happened. Can we desire a bit more? Yes, but full compliments to each of the participants, each of the jewelers, I think, who are able to, who would want to do everything, buy in a proper manner, sell, I think, with have a GST benefit coming in. And when the GST input credit comes to them, they feel, I think, it is advisable for them to sell in a structural manner. So these are structural changes which has happened in the ecosystem. And a bullion, a spot exchange, which becomes a discovery mechanism, a good delivery, which is from India being part of the entire responsible gold and quality gold, wanting to have JMS, and JMS being done through the jeweler's shop, which generally will mean that can you mobilize I think the number is 50 tons, 100 tons, something more. But when you see a 5-year, 10-year time frame, you generally say that can half of demand of India be met through a few of these structural changes which has happened. It can be produced domestically, it can be recycled domestically, it can be a value addition, I think, which can happen. And also, I think, then become more of a policy leader at the world level as well. So it has become, currently it is one of the biggest consumers, but can it determine, be part of the entire policy making as well? So I think what Professor Sahay said and what Som, I think, does, I think, very right. There is a structural part, I think, which has been addressed and addressed well. And we foresee India, it is much, much more simpler, transparent, I think, a digitized manner as you proceed forward.
Jeremy, you're on mute.
Jeremy, you are on mute.
Thank you, Shekhar. So unfortunately, we're pushed a little bit for time, but I actually have one more question for Shekhar. Obviously, we've seen the development of the Chinese market, Shanghai Gold Exchange, international exchange, but the development of the market was really driven, I think, by the banks. In terms of developing new products, bullion banking, we've talked about it, we've heard from Sudheesh. Shekhar, how do you see the Indian banks addressing this? They see this as an opportunity, it's new products coming in, or do you think we're going to see the international banks, the big names from London and New York, will they be looking at entering the domestic Indian market?
I think the banking industry always have been wanting to be part of the entire ecosystem. I think regulatory wise, it was supposed to be facilitated. The good part is, I think, we have moved a step forward. We also want the entire international hedging parts to come to these exchanges or to the ecosystem, so that when you want to do business, you have all the tools available to you in the form of a risk management, in the form of doing business, as well as, I think, to cater to all your customers. I foresee, I think, Indian banks to be active given the development, I think, which has been there. They always have been wanting, and I expect even foreign banks, given the demand which is there in India, given the customer base which is there in India, and given the distributors which happen in India, to be part of the entire ecosystem.
So if I may just add 2 sentences to that response, Jeremy. In fact, this has been one of the issues, the regulatory aspect of bullion banking being permitted to have the entire range of activities which are required, which are pretty much common in London or in America, or now to an extent in China as well. And traditionally, the central bank in India has been somewhat more conservative about bullion banking. But this ecosystem approach that Som very rightly kind of talked about is helping us move the central bank also into this area, because you have an international bullion exchange, you have a domestic spot exchange, and you're having good delivery standards, and you have the banks kind of pushing to have all of this. So all the dominoes coming together increase the chances and the opportunities for all banks, not just Indian banks, but international banks also.
Fascinating. That India is potentially changing so fast, and for hundreds of years having done pretty much the sort of the same type of market, and now we're looking for a dramatic change, and I think it's very exciting. Thank you very much, everyone. Let me just hand back to Taylor.
Thank you again, although I don't need to say it, we've been very appreciative of your contribution today. I do want to pass a little note out to anybody who is watching this back later. If you do have any questions, I'm just going to mute. If you do have any questions throughout the webinar when you are watching it back, please just send these through to ask@lbma.org.uk, and we will certainly try to answer those for you. We do have some upcoming webinars. So we do have the Global Initiative and Illicit Gold Markets webinar next week, which we're very much looking forward to. This is with our Head of Responsible Sourcing, Alan Martin, and we also have Marcina Hunter, the Senior Analyst for Global Initiative Against Transnational Organised Crime, and they're going to talk about their report on illicit gold markets in East and Southern Africa. And then following that, on the 27th of May, we have a webinar on ESG and mining. So we have Neil Harvey, our Chief Technical Officer at LBMA, Grant Berenger, the Group Sustainability Executive at the Barrick Gold Corporation, and Edward Bigham, the Senior Advisor from World Gold Council, your colleague at Sutton. They're going to just have a good discussion about what's going on in ESG and mining, given everything that we have seen over the past year and more. So I really, really, really hope that you're able to join us for those two. They will be live, and we're very much looking forward to seeing you. If you have any questions about this webinar, that webinar, any webinar, you can find out anything about that on our new website or on our social media accounts. So without further ado, thank you again to Jeremy, to Shekhar, to Sudheesh, to Arvind, to Somasundaram, and have a lovely, lovely weekend.